In our last video, we covered the strategic and financial decisions that come with inherited real estate, how to evaluate the options, run the numbers, and avoid the most common structural mistakes. But underneath all of that is a question we didn't spend much time on. Why do heirs make the decisions they actually make, as opposed to the ones the math supports? That gap between what's financially optimal and what people actually do is where behavioral finance comes in. And when it comes to inherited wealth specifically, the research tells a story that's more nuanced than the usual narratives about windfalls and reckless spending. Today, we're going to look at what the evidence actually supports about how high net worth Americans behave after inheriting wealth. We'll cover the income volatility that often follows inheritance, how identity and ambition shape financial decisions, what the research says about risk tolerance versus risk behavior, the specific behavioral biases most likely to affect heirs, and how tax structures quietly steer many of those choices. Before we can talk about how heirs behave, it's worth establishing who and what we're actually talking about. Despite the cultural narratives that inheritors are young, data shows that most people inherit money between the ages of 46 and 75. Furthermore, the primary source of these transfers comes from parents. Inheritance is predominantly a midlife event. The concentration of wealth is also worth unpacking. Cerulli estimates that approximately $124 trillion will transfer through 2048. More than half of that total coming from 2% of households that are currently high net worth or ultra high net worth. Among wealthy Americans specifically, RBC's 2025 survey found that likely inheritors expect to inherit an average of $2.1 million. That means that the behavioral patterns most relevant to high net worth financial planning are not about young adults navigating unexpected money. They're about established, mid-career professionals, often already financially sophisticated, receiving meaningful wealth during a period of life that already carries its own complexity. One of the more underappreciated effects of a significant inheritance is what it does to the heir's income, not just about the amount of it. Research shows that using federal tax and Social Security records found a consistent pattern after a parent's death. Investment incomes rise and wage earnings fall. For heirs of wealthier parents, the reduction in earned income is more pronounced. On the surface, this might sound like a straightforward improvement. More passive income, less dependence on a paycheck. And in many ways, it is. But it also introduces a different kind of financial experience, a reduction in perceived stability and continuity. Wages are predictable. They arrive on a schedule in inconsistent amounts, and they don't fluctuate with market conditions. Capital income, such as dividends, rents, distributions from a business or a trust, can be more variable. It can be higher in good years and lower in bad years. Markets move. Vacancy rates shift, interest rates change. What that means practically is that many heirs trade the stability of a salary for a capital income stream that can feel less predictable, even when your net worth has increased significantly. That shift in how money arrives is the psychological experience of financial security. This dynamic is worth acknowledging directly, because the planning implications are real. Beyond income, one of the more consistent findings in recent wealth transfer research is that inherited money is not processed as neural capital. For most people, money carries meaning, and that meaning shapes decisions in ways that purely mathematical framework doesn't fully capture. Bank of America's 2024 study of wealthy Americans found that younger investors are significantly more likely than older ones to consider the intended use of an investment, a company's value, and even the sentimental significance of an asset when making financial decisions. Equitable's 2026 research on millennial inheritors found that 93% say it's important for an advisor to align their personal values and goals, not just their return objectives. This shows up in how heirs allocate money after an inheritance. Heirs who frame inherited wealth as stewardship tend towards long-term investment, philanthropy, and disciplined allocation. Heirs who experience the same money as autonomy or release, freedom from constraints that they didn't choose, are more likely to spend sooner, shift career priorities, or concentrate capital in identity-linked investments. Neither of these orientations are inherently wrong, but they lead to meaningfully different financial trajectories, and they're rarely discussed explicitly. The practical implication is that understanding how an heir relates to the money they've received is not a soft or secondary concern. It's one of the most predictive inputs on how they'll manage it. The relationship between inheritance and risk is one of the more nuanced areas in this research, and it's worth discussing because the popular assumption gets it somewhat wrong. The common narrative is that inheritance makes people reckless, that sudden wealth leads to outsized bets, lifestyle inflation, and financial decisions that wouldn't survive scrutiny. However, Federal Reserve research found that risk tolerance, the underlying psychological preference for or against risk, is fairly stable over time. Changes in income or wealth have relatively weak effects on how someone actually measures on a risk preference scale. People don't fundamentally rewire their relationship to risk because they inherit money. What does change is risk behavior. Separate research found that receiving inheritance meaningfully increases stock market participation, especially when the inheritance is larger than anticipated. The behavioral effect is less about changing who someone is and more about expanding what they do. Inherited wealth gives people the capacity to act on risk preferences they already had, sometimes encouraging them to pursue positions they couldn't previously access. The planning implication is that risk conversations with heirs need to distinguish between capacity and preference. What someone is now capable of taking on is not necessarily the same as what they should. With that framework in mind, let's look at how the specific behavioral patterns the research identifies as most relevant to inheritors. The most well-documented is avoidance. A 2026 study found that 42% of inheritors over age 50 had spent their entire inheritance by the following survey wave, roughly 1 year later. Each inherited dollar translated into only 61 cents of next wave net worth. The authors interpret this not as primarily as reckless spending, but as a pattern of consistent grief-linked avoidance. When money is tied to loss, engaging with it thoughtfully can feel difficult. Avoidance is often the path of least resistance. The second pattern is mental accounting, the tendency to assign money to specific categories based on where it came from or what it feels like it's for, rather than treating it as one fungible capital. Younger, wealthy inheritors show this clearly. They sort money into purpose-driven categories: philanthropy, lifestyle, security, entrepreneurship, and manage those buckets largely independently. This isn't always irrational, but it can lead to under-optimization across the portfolio as a whole. Anchoring is a third pattern, and it operates more subtly. Heirs often arrive with inherited reference points: a parent's advisor relationship, the original purchase's price of a property, a family's long-standing allocation to a particular asset class. Those anchors can make it harder to evaluate decisions on their own merits. And finally, overconfidence. While not directly measured in most inheritor-specific research, is at least consistent with what younger high net worth investors report. Greater confidence in their ability to identify opportunities in alternatives, private markets, and emerging technologies. What's notable about all of these biases is that they're not signs of unsophistication. They're predictable human responses to an event that is simultaneously financial emotional, and relational. Recognizing them is the first step to managing around them. When you bring the research together, a consistent picture emerges. Inherited wealth changes how heirs experience money, its source, its meaning, and the decisions it demands of them. The financial decisions that follow an inheritance are shaped by a combination of forces that don't always point in the same direction. The emotional weight of where the money came from, a shift in how that income is structured, an expansion of what's now possible, the behavioral patterns that show up under complexity, and the tax and legal frameworks that constrain the timing of those decisions, whether an heir is ready or not. Understanding all of that doesn't make the decisions simpler, but it does make them easier to navigate. Because the heirs and advisors who tend to do this well are the ones who treat inheritance as a process rather than an event. They build in time before making large changes. They separate what tax rules require from what the portfolio strategy should be. And they account for the fact that money arriving in the context of loss carries a psychological weight that math alone doesn't capture. In our next video, we're shifting from how wealth is received to how it's managed at the portfolio level. We'll look at how to evaluate a portfolio the way a chief investment officer would, the key questions used to assess whether individual investments fit together, align with long-term goals, manage risk appropriately, and support a cohesive wealth plan. Because once the behavioral and structural decisions around an inheritance are made, the next question is how to manage what's there.